And as really the person responsible for the largest venture capital firm the world has ever seen, I'd like to talk to you. We've heard here going from 1 to 4 billion people, wiring the continent, etc. But let's talk, if we could, what sectors are you most excited about when you're sitting with a portfolio of 88 companies that you've bought just in to the first fund, the first Vision Fund?
So, if you look at SoftBank Group as a whole, and then the first Vision Fund has 88 investments, where we happen to be the largest shareholder in 87 of them. And the second Vision Fund has roughly 7 investments, and there are half a dozen more in the pipeline. So we had our first CEO conference in Pasadena last September, where we had 110 CEOs for 2.5 days interacting with each other and doing business with each other. But to answer your question, Mike, where are the big disruptions? We are geography agnostic. We have investments from Latin America, where we started investing a year ago, to, of course, US, China, Southeast Asia, India being a big part of it, and Europe. The sectors, I believe, that have performed well with a small amount of capital and is the biggest part of the US GDP expenditure is healthcare, life sciences. If you look at our life sciences assets, and a bunch of them have gone public, like Guardant Health, which uses liquid biopsy and Illumina machines to do gene analysis and detect cancer. The cost per test has dramatically dropped with scale. The accuracy of the test has improved substantially. We invested $260 million a year and a half ago to own a third of the company, 35% of the company to be precise. Its market cap is roughly $8 billion. So the investment has gone up 6-7 times. And Vir Bio, which is coming up with drugs for infectious diseases, 10x Genomics, Roivant, which is a platform for drug discovery. So life sciences, without taking a view on a particular drug, but using platforms that are using data and AI, and we have a few more in the pipeline right now, where the focus is very simple. A, detect diseases cheaper.
Rajeev, let me just stay with the bioscience area. I think the general public or the investors or people following SoftBank really have very little knowledge of this unbelievable commitment you've met to bioscience. And I think you know, as we've discussed over the years, that it's our feeling that this century will be the century of biology, where biology is not just health, it's food, it's energy, it's bioterrorism, and maybe someday our computers are based on bio. You have gone into many sectors. What talent did you bring together in building Vision Fund that allowed you to go in biosciences?
So we have a couple of domain specialists, research fellows, MD, PhDs from Stanford, a couple of MDs who are practicing doctors. So we have roughly 3 or 4 domain specialists, and of course then we have, but we are not betting on a compound or a chemistry, whether it'll work or not work, whether it's in phase 2 or phase 3. That's not what we do. We marry data sciences and AI along with life sciences to make better predictions. So we will not invest where we take a view whether this drug is going to work for Alzheimer's or not, because that's not, there are better people who are doing biotech investing to do that. But when we marry life sciences with platforms that use data, like Guardant Health, to get better every day as they have more data and millions of people that they're testing, they're able to predict with 99.9% accuracy without doing a physical biopsy, whether you have lung cancer, what stage. And then the next phase would be investing in companies that will reduce the cost of healthcare by figuring out what treatment is suitable, again, given AI and data, because they'll have data of whether immunotherapy is going to work or not, whether this kind of chemotherapy is going to work, or that kind, because every gene, every human being needs customized medicine, and it reduces the cost dramatically because you don't have to experiment. You replace the human talent with the machine having the data to recommend the kind of treatment, and that's going to reduce healthcare costs dramatically.
I think just as a background for our group today, there was a commission set up by the governor of California, the 5th largest economy, and it was called the Personalized Medicine Commission. I was one of the commissioners. 9 months into our work, we changed our name to Precision Medicine because we could be precise. And as you've just pointed out, Rajeev, when we submitted the report at the 2-year mark to the governor, the name was changed again to Precision Health. We're just not going to treat you when you have a disease. We're now going to be precise on preventing you from having a disease. So, large commitment to bioscience. I know you have a large footprint in Silicon Valley, where between the East Bay and Berkeley, Stanford and San Francisco, UCSF, you have a large bioscience community. Take us away. We've started with bioscience. What's another area that excites you?
Well, the other big industry on the planet, there are two more that is of interest. Of course, the consumer as a segment is very interesting because that's growing, it's changing with the millennials, the youth. But financial services, it's one of those last frontiers where the regulators have protected and have actually created oligopolies. If you go back pre-2008, you had 50 great financial institutions you could go to as a service provider. Post-2008, a dozen of them went out of business, others got merged. So, and not all FinTech is going to work because there is value to taking deposits, there is value for customer services, but there's tremendous disruption capacity across financial services, whether it's, and payments is already doing that. You have PayPal, which is worth $125 billion, and you have Square, and so on. But insurance, the way insurance is distributed, we have Policy Bazaar in India, where you can distribute it and sell insurance substantially cheaper without very heavy brokerage costs. How do you reinsure? How do you measure risk? Lending. Because there's a huge tail of lending that doesn't happen with small SMEs, with retail, and with AI and data sciences, the ability to do the credit work, because a 10 million loan might cost the same to process and to approve as a 100 million loan, because you just do the same due diligence, the same paperwork, you got to go check, and more with data and the amount of data available on every individual in this room that can be mapped with facial recognition technology, et cetera, et cetera. I mean, US is much more advanced with FICO scores and so on, and even within a FICO score, to be granular and be able to lend to a small SME $20,000, $30,000 to a consumer. Companies like Greensill, Oak North, others that we have, financials and insurance. So lending, extending credit, that is, it's a big GDP multiplier, using AI and data. But lending is an interesting kind of game because without deposit base, without liquidity, just lending as a platform, and the biggest lending success in the world today is one of our portfolio companies not in the Vision Fund, is Ant Financial. I mean, it has become the biggest, the amount of transactions that Ant processed in 2019 was bigger than the GDP of China. $17 trillion of payments went through Ant. And you have that data now of the merchants, of the consumers.
Now, one of the things that concerns me, Rajeev, is that I made a small investment in Ant Financial at $150 billion pre-valuation, and you made a larger investment at less than a few $1 million. I'm a little concerned about my entry versus your entry there. But someday, as you outline, Ant Financial might be the most valuable financial institution in the world.
Without a balance sheet, because they use the balance sheet of existing banks. So it's without competing with the existing financial system using their balance sheet, just providing the front end. So financial services is an exciting domain across insurance, across banking, lending. Greensill, an amazing company. They just took one segment. Greensill is global. They do receivable discounting. They go to the Walmarts, the Boeings, the Airbus, large companies who have thousands of vendors, suppliers, who get paid 6 months, 3 months, 4 months later. These are small SMEs who need the money now. But there was a disconnect between the credit quality of Walmart and the small SME whose cost of borrowing was very high. So what did they do? They took 25 insurance companies. They got them wrapped, those receivables, and sold it in the market as single A, double A bonds. Let me add one aspect to it. What they added 2 months ago is payday financing at zero cost. They went to NHS, National Health System in the UK, and said, look, you have 1 million employees and consultants and vendors. Who are getting UK government risk, but they get paid end of the month. So they developed a retail app, which everybody now has, where they know how much salary they've accrued for the month. They can transfer it to their wallet, go spend it, and they don't charge any interest on it because the cost of financing is 1%, it's UK government risk. But it's an amazing customer acquisition strategy. Now they have 1 million people on their app in a few months that they can lend to, they can sell insurance to, they can cross-sell so many things. So financial services is an amazing opportunity. And the last, our biggest investment is mobility.
Before we go there, I just want to stay in financial services for one. You yourself are one of the most sophisticated individuals in the world, and with your career in finance, financial structures, etc.
I've forgotten it.
No, you haven't, not in our discussions. But what struck me here, Rajeev, is those FinTech companies, many of which you have funded and are largest shareholder, when I look at their default rates over the last 10 years, there's very little difference in their default rate versus your traditional due diligence effort, people coming in, giving you their financials, interviewing them, etc. So by going on the web and mining all this data in a matter of a few seconds, they have been able to match, in a sense, the credit history of what we did traditionally with fundamental analysis. And we haven't been in a significant downturn yet, but it's quite possible, like medical, like life sciences, where our AI is going to replace radiologists or pathologists in reading MRIs, CAT scan, mammograms this year, that this FinTech effort is going to replace lending, not just the issues of insurance or access to wages, etc. Has this surprised you, or did you expect it?
No, so the couple of things, you mentioned a few aspects. So, and financial has proven that it works in scale. If you have the right data, and you're absolutely right, what is the unknown? Since 2008, we had a small wobble in 2011 with the European crisis, with Greece and so on, where we had a credit crisis. So since 2008 and 2011, to a limited extent, we have not had a credit crisis. So we'll see how many of them pass the mustard, because we have had too many of them grow. And that's where your asset-liability mismatch is critical. Are you laying off the risk, or are you keeping the risk? If you're laying off the risk, you'll be fine because you are like Ant Financial. Do you have matched maturity deposits and liabilities to finance in a downturn? Because there will be losses. As we know with credit over 25 years, every decade or so there will be a crisis. And with tremendous liquidity in the economic system today, of course defaults are lower. Of course, property asset values have gone up. Consumer debt has grown dramatically. So we'll see how many of them pass the test of the next credit crisis. But if your model is right, where you have matched assets with liabilities, you have deposit-taking ability. And I'll give you an example of Grab, which is our biggest transportation investment in Southeast Asia. They started a payment business. Coupang, biggest e-commerce company in South Korea, started a payment business, has grown dramatically, and now they've started lending on the back of that. So the cross-selling is becoming interesting. If you look at Ant Financial, a third of their customers are coming from Alibaba. The merchants, the consumers, you just pay later. You buy a pair of Nike shoes, you pay in installments over 3 months, don't have to pay right now. Increases the e-commerce business. So knowing the credit properly, a lot of them did not use AI. All they did was take limited data. You have to be able to have access to customer behavior. And that's where traffic is key, which is why Alibaba is successful. They have tremendous traffic. They know tens of millions of merchants for years, how much profits they make, what they sell. And a very successful FinTech investment of ours, Paytm, now has 140 million people transacting every month, 70 million on a daily basis. And they're just going to start lending on the back of that from April this year, because they've had 4 years of history and lending not to the consumers only, but to the merchants who they know, and they collect the money from first when somebody goes and buys something. Lending working capital to those small merchants in small towns in India. We did a small JV, Paytm and Yahoo Japan, called PayPay in Japan, just a year ago. In 1 year, now they have 20 million people in Japan, which is 120 million population, using PayPay. So taking them global. So financial services is going to be, and it doesn't have to be complicated. It's simple stuff.
Let's move on to, you mentioned mobility.
Mobility is a big part of our investment. One of them is public, Uber. We're the biggest shareholder in Didi, Grab, Ola. That's one. And mobility to me is the whole vertical, whole value chain of vertical. Not just moving people, but moving food delivery, which is becoming bigger than actually moving people, because people eat 3-4 times a day. Then going even more upstream, dark kitchens, and producing the food. And once you have that, you can cross-sell so many other services, repairing cars, selling auto insurance, selling used cars, because your drivers are the biggest consumers of cars. Didi drivers with 25 million rides a day are the biggest buyer of cars in China, and biggest seller of used cars in China as one entity. And they need to have their cars repaired, they need to get car insurance. There's so many ancillary services. Grab in Southeast Asia has started using their mobility services to deliver food now, payments, as I mentioned, grocery, etc., because they already have the infrastructure. So mobility to me is not just moving people like a Didi or Uber. It is DoorDash and Rappi delivering food. It is dark kitchens like Park Jockey, Reef, which is converting parking lots in the US into kitchens.
So I want to switch, if I could, Rajeev, to value added. And let's look at it both ways. I know when I was very focused on these areas on a daily basis, the question is, what is the value added? Short-term money today yields, depending where in your world, anywhere from minus to very little. And so I am now building my company, and my decision is, who do I want as my financial partner? Who do I want to take capital from? Do I want to take it from SoftBank? Do I want to take it from another firm? That's one side of the occasion. Two, I have numerous people approaching me to invest in their venture capital fund. Why should I be choosing SoftBank versus anyone else in the world?
Okay. Just one kind of clarification. We are not a typical venture capital firm because we don't invest early. We are a mid-stage investor. Once the company has reached certain point of maturity, escape velocity, so on and so forth, and is a proven company with dominance and proven unit economics. So let's answer the first part. Why would an entrepreneur take our money versus from many other providers of capital? And I've seen that transformation. I mean, the fund is less than 3 years old. Started investing in May 2017. We're approaching our 3rd anniversary. We were unknown. Yes, we had, as SoftBank, have been investing for 25 years, from Yahoo to Alibaba in '99, etc. But E-Trade and etc. But once the flywheel, as I said, comes into action, there are a couple of reasons why an entrepreneur would want us. The obvious ones are brand and amount of capital available, the long-term nature of our capital, that we will be partners for the next decade if required. But the more important ones to me are the ecosystem. We are global. We have offices now in every part of the planet, from Mumbai, Shanghai, Beijing, Singapore, Hong Kong, in Latin America, in Brazil, and of course London, San Francisco, and Tokyo. Riyadh, Abu Dhabi, we have a dozen folks in Abu Dhabi, bringing these companies into Hub 71, bringing these companies locally. So the ecosystem, when, as I mentioned about Paytm going and partnering with Yahoo Japan, or an Automation Anywhere, which does robotic process automation for mid and large companies, it takes 12 months to break into those clients. The B2B businesses sales cycle is 9 to 12 months. You have to do a beta. But when you are in an ecosystem where the Vision Fund is the biggest investor, it's easy, if it's a win-win situation, to marry our portfolio companies to win over other business clients successfully. And the examples are numerous. A Grab working with Ping An Good Doctor to do telemedicine in Southeast Asia, because they already have the footprint. For a company from China to go in and establish that footprint is nearly impossible and too expensive. To kind of leverage off the traffic, to get the mentorship, to have the ability to take a WeWork, which has been in the news, but WeWork Japan is profitable. And WeWork Japan has 98% occupancy, because why? SoftBank Mobile has several thousand SME sales force selling mobile services, broadband, to SMEs in Japan. And the WeWork sales force, to fill up their buildings, could use that sales force. And an Automation Anywhere had 0 employees in Japan when we invested in January 2019, a little over a year ago, has more than 150 employees in Japan. So the global reach, the ecosystem, our operating group, which has 45 individuals, ex-CEOs from Starbucks and hotel chains and others, working with our portfolio companies to help advise them, to help them grow. And the last benefit is very important too, because that's what you mentioned. We help our companies also raise alternative forms of capital apart from equity, get financing from banks, which is much cheaper than raising equity, especially the profitable ones, especially ones which have, like a Katera, building homes. They have receivables. They need working capital. Instead of using equity as working capital, we get them bank lines. So we help them with capital market activities.
So you brought them all together in Pasadena. What were your goals that you were going to plan to achieve by having them all in one place?
So for 2.5 days, we arranged, and we put a lot of effort into it for every CEO. We gave them a list, like you do your conference in LA, which company CEOs do you want to meet? We set up one-on-one meetings between all the companies. That's all they do for 2.5 days, meeting each other, learning from their experiences. Somebody who's doing rideshare and Ola in India can learn from Didi. What are the experiences and not repeat the mistakes? So we set up one-on-one meetings for 2.5 days between all the CEOs, and they follow up after that.
So number one, long-term permanent capital for the company. Number two, the ability to propel their business, open doors. 3, the ability to help them on their financial structure. For the investor, we get the benefit of one, Masa willing in many cases to subordinate his interest to the investors, but structurally, but number two, your knowledge across 100 companies on what works, not making the mistakes. Well, how is it working?
Yeah, so we have learned a lot. I mean, as I said, we as an institution have been investing for 25 years, but the scale is only 3 years old. And when you learn, you take the feedback loop in, you course correct, and we learned quite a bit. We have 88 companies across the globe, Grab, life sciences companies. We have Auto One. You name the sector, you name the geography. Success, I believe, we have had 8 IPOs. We have had 2 exits in just 2.5 years, Flipkart and NVIDIA. We have had 8 IPOs. The public companies that we invested in are up roughly $4.5 billion. Again, we didn't expect 8 of our investments in just over two years to go public. We were looking at a longer horizon. And they go up and down. Uber, since January 1st this year, is up $2.5 billion in value. Our entry point was $33. It's at $41. It was at $47 post IPO. It'll go up and down. We have a long-term view on it. So there are at least 40 to 50 winners that I meet them every week, 5, 6, 7 of them. We help them that are in the portfolio. A dozen or more will go public in the next 18 months at the right time. There's no rush. They don't need capital. It'll be more for ESOPs, and a lot of them won't even raise capital in the IPO. They will just do a direct listing to provide liquidity. There's a lot of latent value. We are marked at carrying costs in most of them. And there are giants in there, like I said, ByteDance, DiDi, Coupon, Grab, Paytm.
So Rajeev, as I was looking at SoftBank and the Vision Funds portfolio, it looked to me, and this is just cursory, that the value at the start or January of last year was around $240 billion.
This is the group.
That's right. Both the Vision Fund.
Not the Vision Fund, but the group, yes.
Right. So talk to me about the group. What has happened in the last year?
Well, the group is the tree. Vision Fund is just a branch of the tree. The Vision Fund, you have to look at it, is not a fund with 100 LPs or 500 LPs. It is 3 principal LPs, and then there's Apple, Foxconn, and a few others, single digits, of which a third of the capital, $33 billion, is from SoftBank as equity, first loss. So it's our own capital.
So I just was kind of looking at the numbers, and as an outsider, with all the noise, it looked to me like SoftBank had a fabulous year, going up $60 billion. We'd all like to be penalized that occurring.
Noise is the right word.
Today, as you look at the future, maybe talk a little of some of the lessons learned. Also, Rajeev, you went to Penn, you went to MIT, you worked for financial firms. What has prepared you to manage this diverse portfolio throughout the world? And with companies, you've identified 3 areas: life science, financial services, and mobility. But you have a few other verticals you're in also.
Oh, we have a dozen verticals, from e-commerce, which is big across different segments, selling used cars, selling homes, like Open Door, Compass, doing residential broking, to numerous others. So
tell me, how do you manage? Tell me the background of the team you've assembled. How do you manage this diverse portfolio?
So that's a good question, because if you look at our time today, I would say 70 to 75% of our time. The first 2 years was about investing. 75% of our time today is spent in managing our existing portfolio, 25% in investing. The good news is we don't have to go out and find the investment opportunities per se, because we will get the call. There is 90% plus of any growth company which is using technology to disrupt an industry anywhere on the planet, when they are looking for capital, will call us. So we don't have to go look for investment opportunities because we're not investing early anyways, where we have to fight over investing $20 million in an early stage company. So we will get the call from the reasons I mentioned. So 3/4 of our time is now spent in growing our winners and our companies, and of course, also helping companies that get into a little bit of trouble, like WeWork. And 1/4 of our time is spent on investing. We are understaffed. We, over the last 18 months, have hired, as I said, 45 people in our operating group who are solely dedicated to sit on boards, help our companies, without getting actively day-to-day involved, finding independent board members. There's a team that prepares companies to go public, to get audited financials. How do you prepare US GAAP financials? How do you get the right governance? So we're just 300 people doing control functions, finance, legal, compliance, valuations, you name it. There are 140 investment professionals, from associates to managing partners, and there are 45-odd operating partners. I see that number growing, not coming down. Of course, there's some natural attrition, small. It's been close to nothing so far. But as the number of portfolio companies grows from close to 100 to whatever it is, 120, 30, 40, 50, the workload grows because you get married to these companies for the next 5 to 6 years till they go public. And it's a lot of work. Investing is, I believe, the easier part, helping them grow, holding their hands, advising them, taking them into new geographies, into Latin America, into Asia, and so on, helping them raise different forms of capital, getting them the right governance. It's so much work.
So Rajeev, kind of in closing, for people that are with us here today in February of 2020 in our Middle East and Africa Summit, in the last day or so, we've had a ruling in the United States which will have significant changes in the United States and benefited greatly, and that's the approval of the merger of Deutsche Telekom and Sprint. With a significant investment by SoftBank, really keeping Sprint alive all these years and developing, and this was Masa's vision a number of years ago. Sprint, with the largest potential footprint of spectrum of anyone, coupled with Deutsche Telekom's access to capital and a very aggressive and innovative management team. One thing we're sure of is 5G will dramatically increase the pace that it's developed in the United States. This also will free up SoftBank, enormous time that was spent on Sprint and an unbelievable amount of capital. And just in the last day, SoftBank's holdings of Sprint stock have gone up 12 or 13 billion in one day. So I see this really freeing a large part of the SoftBank team and freeing over time significant capital as that investment is liquefied.
Is that a question or statement, Michael?
No, but it seems to me now that working for the Vision Fund or SoftBank is potentially one of the most exciting jobs in the world.
So look, if you look at Masa's genius, people, and you have to look at it over a 20-year period, he's an amazing operator. He's not just an investor. People forget, he built from scratch SoftBank Mobile in Japan. Vodafone Japan was going downhill. Fine-tuned the payment system, the installment plan, got exclusivity on iPhones, et cetera, et cetera. Same with Sprint, designing the network of Sprint down to the detail. Where should the towers go? Yahoo Japan, now ARM, Vision Fund companies. I mean, he's a detailed man who works 7 days a week, and he's one of the few on the planet that has created value of this immensity of Alibaba, Sprint, Yahoo Japan, SoftBank Mobile. Not one, 4 or 5 large institutions that have market caps of 30 to 600 billion. So it takes time to be able to see the future as to where the world is headed, what is going to get disrupted, and how to approach it. And as we know, the quality of mobility, and we've seen that in India, is a direct correlation and the best GDP multiplier that is possible. India bringing, with Geo, 600 million people into the net had tremendous impact on the GDP of India. And we'll see the same effect in the US.
Well, Rajeev, it couldn't be more exciting. I think the opportunities at the Vision Fund and Vision Fund 2.
We're still young.
And you're only 3.5 years or 3 years old, really. And it's amazing what you've accomplished. And with Strive now focusing on wiring all of Africa and the potential that you have there, it's an exciting place to work. In closing, how do you motivate these employees? You've brought many of the most talented people in the world onto your team. How do you motivate them besides the excitement of working for this company? But how do you keep them with competition for talent in the world today?
Well, I keep telling them that they should pay us for the education we provide. But, anyways, look, technology is going to shape the way the planet is in many ways, every segment, every part of the GDP. If you look at internet, which was a big revolution from 99 till 2019 for 20 years, it impacted maybe 10% of the GDP of the planet. Impacted e-commerce, it impacted advertising, digital advertising, how people saw movies at home. But artificial intelligence and technology and data sciences will impact every aspect of the GDP. It's going to be a bigger revolution and a bigger GDP multiplier globally than the internet was. That's just the vehicle. So employee motivation, here is an employee which has the ability now to globally work with the best founders, great companies, learn from their mistakes, then just be the medium that learns from them. What have I achieved in 2.5 years? I learned from my founders. So just getting educated by our own portfolio companies and being a transmitter of that knowledge to other companies, we are ourselves like AI machines who are learning every day and improving and being able to then pass it on to the next generation of evolving and emerging exciting companies around the world is a fascinating experience.
Well, Rajeev, we are all excited, one, about what you've achieved in a few years and
Thank
what
you.
you're going to achieve in the future. And when I interviewed Masa a couple years ago, it was so vivid when he told me he was on the streets of Berkeley about 10 years after I left, and he opened a magazine and he read about a computer on a chip, a microchip. And he's standing there on the corner, tears coming into his eyes, thinking about a chip and how it's going to change all civilization and the most important thing that was ever created. Today, most of us are crying that we didn't see the vision of Masa and participate in it in our own portfolio. So congratulations on your success.
Thank you.
And we look forward to Vision 2, 3, and many more to come.
Thank you. Thank you, Mike.